We just heard Poland say they're going to have 30% of their reserves in gold now. And we know other countries are doing this with gold and with Bitcoin, right? And so there's already this sense of let's not be so reliant on the US dollar.
I'm not surprised that gold is taking off, and that consolidation we had since April, that's been broken out and is getting steeper and steeper. So yeah, I'm holding on to my gold, my silver, trying to add on. It's getting more and more difficult because you need more and more fiat to exchange for them. And also the miners, they look very good as well. So that's how I see the markets for now.
The current gold rally is driven by weaker than expected U.S. economic data, including a soft producer price index and slowing job growth, which have increased market expectations for a Federal Reserve interest rate cut at its upcoming meeting on September 17th. Tariffs have made a considerable dent in the value of the dollar, with the dollar trading at 97.7 on the DXY Exchange on Saturday. This index measures the value of the greenback against a basket of foreign currencies. In January, the dollar was trading as high as 110, but it plummeted after Liberation Day tariffs were announced. A 17-year support level for the US dollar has been broken. Prominent market experts Gareth Soloway and MarioInnecco discuss the recent market trends. Gareth Soloway strongly believes that the DXY's technical breakdown is a global wake-up call, ignited by the Liberation Day tariffs. This signals a sustained decline in the dollar, with the world shifting toward gold and Bitcoin. In his outlook, Soloway explains why countries like Poland are moving to hold 30% of their reserves in gold, with the world quietly diversifying into Bitcoin. According to the World Gold Council's Gold Demand Trends reports, investment demand for gold typically increases 15 to 30% during major geopolitical crises. This pattern has remained consistent across decades of market data, reflecting the enduring trust in gold's protective properties during uncertain times. Countries like China, India, and Russia have redoubled their efforts to wean themselves off the US dollar. De-dollarization and central banks' gold-buying spree will remain a long-term catalyst for gold that will put upward pressure on the price of the yellow metal. Before we dive into Gareth Soloway and MarioInnecco's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
This is the DXY. Remember, the DXY is the US dollar index versus a bunch of currencies, basically the main currencies out there that we've discussed. And what we could see here is a troubling signal, right? You had this beautiful support zone basically on the DXY between 100 and 101.5. So 101.5 down to 100. And this zone was holding for multiple years. And again, we're looking at the daily chart. And so you can really see how over the course since 2022, at this point now, believe it or not, it's over 3 years, that was support until it broke in April. And again, that coincided with the Liberation Day tariffs that were announced and the subsequent market fall. And really, in all fairness, to me, I look at that event as being a wake-up call for all the world, meaning that all of a sudden the US, which has everyone so reliant on the greenback, the US dollar as the reserve currency, a lot of countries said, wait a minute, we are way too reliant on the US dollar. We basically have all our, safety net in the US dollar as the reserve currency. We need to begin to diversify away. And that, to me, listen, it was inevitable that it was going to happen eventually. But in my opinion, that was the trigger point where countries said we can't be so beholden to the US. We must start diversifying away. Now, if we flip over to the chart, you could see what happened. We broke that level. We had a retrace, but then look, again, remember, when you're in technical analysis, when you're doing it on a chart, support, once it's broken, becomes resistance. That's one of the key principles of technical analysis. And you can see how it went up. The dollar, the DXY went up into that zone, rejected, came down and tagged support here, then went up again and tagged that resistance zone again. Notice a lower high, though. And that, again, is a bearish signal. And now we've come back to the downside. Now, what's important here, folks, is if we zoom out, this zone on the US dollar has been a long-term technical support since 2008. Now, 2008 is important because it was the beginning of kind of the dominance of the US Federal Reserve amongst all central banks, right? So before that, yes, the US was dominant, but it was really the US and the way the Federal Reserve reacted led the world, right? Basically whatever the Fed did, the rest of the world did. The European Central Bank, the Japanese Central Bank, they all followed suit. And that started again this kind of longer term uptrend of support on the US dollar. However, we are now getting into this same support line. And to me, it looks like there's a decent chance it breaks, which if it does, the long-term uptrend that's lasted since 2008. So we're talking again, 27 plus years now of uptrend. Kind of ridiculous, is it? No, it's 17 years of uptrend. I mean, incredible still. 17 years of uptrend is now at risk of breaking. And that again is not, when you have these trend lines, and this is another key principle of technical analysis, when you have these long-term trend lines that last more than, 5 years, 10 years, 15, 20, 30 years, they're not minor. We would refer to them in technical analysis as major, meaning that when you get a break of one of these support lines, you don't just go like a little bit below and then go, okay, let's float back up. Like usually it's a break, and it's not necessarily a crash, but it's a break, and then you maybe a small bounce, and then lower and lower and lower and lower. Essentially, it starts this point where you see a longer down move that'll come into play, and essentially that coincides with what I think is happening is diversifying away from the dollar as the major powerhouse of reserve currencies. And by the way, we just heard Poland say they're going to have 30% of their reserves in gold now. And we know other countries are doing this with gold and with Bitcoin, right? And so there's already this sense of let's not be so reliant on the US dollar. Now, again, a weaker dollar, it has positives and negatives, all right? The US, for us in the US, a weaker dollar means our dollar on anything we import, it goes less, right? We can buy less because it's weaker. In terms of exporting, that's another story. It actually helps exports, right? So if we produce things in the US, then it's good because it can be cheaper to those overseas. And so again, you could argue the positives and the negatives. I'm just here to discuss what the charts are telling us. And again, this is really where it comes down to on the DXY. The DXY has current support basically between 96.75 and 94.50, we'll call it. And essentially that is a zone of support. We've already tested the high end. Now we'll see if we come down and maybe make a lower low, bounce again, lower low. But ultimately, if this longer term breaks, this longer term trend line breaks, that's where things get very, very nasty on a longer term basis. And by the way, don't be surprised when you have one of these long-term trend lines, you know what your ultimate end game is? All right, this is pretty remarkable, and it's going to shock a lot of people. But, again, keep in mind, you don't come right down and break straight down, but you have a down move. And then again, let me just extend this out so I can kind of draw this. We'll leave the arrow there, just extend this out, right? So you have your down move, then you get your bounces and down move, bounces, down move, bounces, and down move. But my point is it's very normal to go and back to the levels we were prior to the uptrend starting as an ultimate downside target. And again, in this day and age, when if anyone were ever to say, hey, the DXY is at 75, let's say, or 71 is the low back then, that would be unbelievably shocking to a lot of people out there. And it will cause issues. I mean, think about the yen carry, the carry trade. I mean, there's so many different factors here that have been built on the back of the strength in the dollar that would start to unravel. And again, you could say, well, where do we put our money? I mean, what should we do in light of what could happen or what likely will happen based on chart analysis? And the answer is really that, again, on pullbacks, you look to buy gold, right? Now, I'm not a fan of chasing. I don't like paying up at the highs on gold. Even if I think gold's going higher, I still wait for a pullback because pullbacks come naturally just like bounces do. Your financial future should not be reliant on one asset or one stock or one crypto or one commodity. Right? Even if it's gold, I still don't believe you should be all in on gold. Yes, it's a portion of my portfolio, absolutely, but we still shouldn't be all in, right? Diversify, diversify, diversify. All right. So quickly, sorry to get away on that little tangent there. You guys know I'm big on these type of things. Listen. I don't call myself like a hardcore prepper, but trading has changed my brain to start assessing risk. And risk is something that you want to plug. Essentially, think about this: you have a bathtub full of water, and there's like 20 holes in it, and there's little water coming out of each hole. You got to plug those holes, right? And that's what assessing risk is. Where is the hole in my financial future, in my life? How do I cover that one? Okay, here's another one. Cover that one. That's really the goal here of us as investors, but also as citizens.
Veteran expert MarioInnecco is holding on to gold, silver, and miners, which he sees as the only real defense against a system that's designed to fail. The decades-long bond bull market is dead. Innecco warns that while yields may dip, the Fed's aggressive rate cuts will fuel inflation, forcing investors out of long-duration debt and into alternatives like gold and commodities. We're already seeing that a major Dutch pension fund is shifting hundreds of billions out of long bonds, with gold and silver set to be the ultimate winners. Historical gold price data from the London Bullion Market Association shows that gold exhibits a negative correlation with equity markets during crisis periods, typically ranging from negative 0.25 to negative 0.40. The world is focused on a conflict in the oil market. Depressed oil prices are a deliberate move by OPEC and Russia to hurt U.S. fracking. According to MarioInnecco, this strategic move is keeping miners' costs down. With analysts still using conservative gold estimates, he warns that mining shares are massively undervalued and set to surge. IMF data shows that oil price volatility during Middle Eastern conflicts has historically displayed a positive correlation with gold prices. This relationship creates a compounding effect when tensions rise in oil-producing regions. Investors seek gold both as protection from the conflict itself and as a hedge against potential energy-driven inflation. Let's get back to the interview.
The Fed is going to be cutting rates with everything going really bananas in terms of the markets. We have time highs. We've got gold and silver gold at all-time highs, silver at 14-year highs. What else? We've got the crypto, Bitcoin craze. Do they really need to cut rates? It could trigger, I've spoken a lot about the crack up boom. That could be the trigger. We could see everything go up, and that would be more a sign of a weaker currency than anything else. We could be on the road to really interesting moves higher. It will favor, of course, the top 1%, the top 10%. The bottom 50% of Americans hardly own any assets. And I think it's just going to make it harder and harder on these people to get through it. It's becoming more and more like let's say Venezuela, Brazil, when they had their hyperinflations, the general stock market was booming, but the majority of the population was suffering. And the other thing, Danny, even if the stock market doesn't continue its melt up, what if there is a crisis? Everything crashes. The Fed will even, they will be even more aggressive. They'll cut. They'll probably stop the QT that they're still doing. They'll start QE. So I'm not surprised that gold is taking off, and that consolidation we had since April, that's been broken out and is getting steeper and steeper. I'm holding on to my gold, my silver, trying to add on. It's getting more and more difficult because you need more and more fiat to exchange for them. And also the miners, they look very good as well. So that's how I see the markets for now. Well, up until 2020, the bond market was in a secular bull market since 1981. And I think now we're not anymore. And I think that's why the 10-year yield has held up at such a high level despite the cuts last year. It's down around 4% now, which is relatively low compared to was a month or two ago. But considering that when the Fed cut last year in September by 50 basis points, the 10-year was at 3.6. So yeah, it might still drop a bit, maybe to 3.5, 3.25, but I don't think in well, maybe in my lifetime if I live until I'm 100, but in my lifetime I don't see bond yields in the US or the UK going back, at least long-term bond yields going back towards 1 or 2%, let alone the 0.3 that we saw in March 2020. So yeah, Secretary Bessent said that his the level he's looking at, the line in the sand is 5%. So it's quite safe right now. But I think the markets are going to realize when the Fed starts cutting aggressively that they've opened a can of worms, i.e., very inflationary environment. And I think the bond vigilantes, people who um, manage money for investors, for funds, for retirees, and they're going to like allocate a bit. They're not going to get out completely out of bonds, but they're going to move it out of the longer end, and they're going to go into alternative investments, not just to the shorter end of the curve. And I think that's where gold and commodities come in. We saw recently the Dutch fund managers like association. They're going to move 300 billion euros of the holdings in the pension funds in the Netherlands to out of the longer end of the bond market, government bond market, to the shorter end, because they don't think the longer end is a good place to be longer term. And what that means is that they expect the value of these bonds to drop going forward, because inflation, and by inflation I mean the creation of currency and credit, is still very high. I mean, you look at M2 in the US, M2 in the UK, M2 in China, M2 in the EU or Eurozone. It's making new highs and still growing massively. And why do they need to cut? Well, because there's so much debt, and when the more debt they create, the bigger the debt burden becomes, the more they need to make sure it doesn't that there isn't any glitches. And I think that's where we are. And that's why I think, the 10-year it's not going to be a good place to be. It might do well nominally, but in real terms, in terms of gold and silver, it's going to underperform, in my opinion. Well, right now, I mean, anything can happen, but the oil market seems to be pretty depressed. And and with the prospects for the economy slowing down, not just in the US, but in other countries, it's probably going to remain there. The other thing could be geopolitical. The Russians and OPEC know that a price around 60 or below 60 is really bad for the fracking sector in the US. So I think they have a much bigger how can I say, wherewithal. They have a lot more wherewithal, OPEC and OPEC plus, to keep, they'd like higher oil prices. But I've noticed that recently they've been increasing production. And I think it's a war against the fracking industry in the US. The fracking industry, could be in real trouble. And so that's why I think oil prices are going to stay pretty steady. And that's going to continue to help the miners. And not only that, Danny, but I think a lot of the miners are still, investors don't realize how cheap they are in terms of, I think the analysts or the investors, or they're accounting for gold at a lot lower price. They're always very conservative, but if gold stays firm, as I think it will, or it goes even higher, that's going to put an even bigger rocket up the mining stocks, I think, not just the oil price.
Investors expect the value of the US dollar to fall, and that depreciation will prompt flight from the greenback and a move toward gold. This dynamic aligns with historical trends, which indicate that over time, the gold price has an inverse relationship with the value of the dollar. Analysts expect gold to extend its run and break through the $4,000 barrier in 2026. As nations, funds, and investors race to diversify away from the dollar, can gold and mining stocks become the cornerstone of global financial security in the coming decade? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.